Well, hey, welcome back. Today we're going to take a look at what is subject to financing in real estate. So if you're interested in finding out alternative ways to get financing in real estate investing, that's what we're going to be talking about here today with respect to subject to financing. What it is, the pros and cons for both the seller and the buyer, the risks, the rewards, and how this could be a great way for you to start buying more properties easier and faster. So first things first, what the heck does subject to financing really mean? You probably heard the term thrown about a bit, and here's what it means. It means that you, as the buyer of the property, are purchasing this property with an existing mortgage already on it. So you're buying the property subject to the existing mortgage, subject to continuing to pay that mortgage. So you're going to get ownership of the property. Your name is going to be on title or on deed. However, the mortgage is going to stay in the name of the original seller. Does that make sense? So you're buying the property, you own it, but the original seller still has the mortgage and the liability in their name. Now, why the heck would they do that? That's what we'll take a look at. So first of all, let's take a look at how does this work? Well, it's really quite simple. So if you find a motivated seller who is willing to sell you their property subject to the existing mortgage that's already on it, then you're going to do a couple of things. First thing you want to do is you want to get a legal contract of purchase and sale that explains everything, that you are purchasing this, you're purchasing the property subject to the existing mortgage, and that the owner is going to still assume all of the responsibilities for the legal responsibilities for that mortgage, even though they're selling you the property. And then you're going to have to make payment, some sort of payment on this. I've done this for as little as $1, $10, $1,000, something like that. Typically, you're buying a property with very little equity, so you're not coming up with very much cash to do these kind of deals. And then the third thing is you want to make sure that you can or you get the actual deed for the property transferred into your name or into a corporate name, or you've got some sort of way to transfer it to an end buyer. You want to make sure that you control the ownership of that property. That's going to be different depending on where you're located, and that's why you need to talk with a good real estate lawyer just to make sure that you're set up properly to do this. So let's take a look at what are the advantages of purchasing a property subject to the existing finances. So what are the advantages to you as the buyer? Well, first big advantage is you don't have to qualify for bank financing for these kind of properties, for these kind of deals. It's already got the mortgage built right in. All you need to do is start or keep paying those mortgage payments and you're good to go. All right. Now, the other advantage is, especially depending on what you're watching this video, is you might actually be getting better interest rates with the existing mortgage that's already on the property than you could on your own by getting your own new mortgage, even if you qualified for one. So you might be getting better terms, you might be getting better interest rate, you might have a longer duration on that existing mortgage than you can get with your own new mortgage on that property. And bottom line is, this is a great way for you to be able to buy a property with little or no money as a down payment. Again, like I said, most of these kind of properties don't have very much equity in them, so you typically don't have to come up with very much cash to do these kind of deals. All right, so what are the advantages to a seller for doing this kind of deal? You might be thinking, it looks pretty lopsided. They're selling the property. They're still on the hook for legally for that mortgage. You're telling them that you're going to pay it, but what guarantee do they have that you're actually going to make those payments? Why on earth would a seller ever do this? Well, again, it doesn't happen all the time, but there are certain circumstances where this just does actually make better sense for a seller. For example, if they're at risk of going into foreclosure. So this happens quite often when people get divorced, they lose a job, there's a death in the family, something like that happens and it throws them right off financially and they stop making the mortgage payment. So if they haven't owned the property for very long, if they don't have very much equity in that property, they might not actually be able to afford to sell that property with a realtor. I mean, think about it. If they bought the property at the peak of the market and they got in with 5% down a year or two ago, and then the market has actually gone down a bit, and now the property is worth less than what they paid for it, and perhaps the amount they owe on the mortgage is more than what the value of the property is, they theoretically might have to pay a realtor literally thousands and thousands of dollars to sell that property traditionally, right? So they can't actually afford to sell the property through a realtor. Perhaps they're falling a little bit behind on the mortgage payments. That's going to create a lot of motivation. So perhaps they want to move on, get on with their life, but this house is just, weighing heavily on them. It's this thing that's just weighing them down financially and emotionally and spiritually. It's just taking them right down, and you're offering them a solution. This is the situation where people would sell the property subject to the underlying mortgage. So again, you got to find a motivated seller who needs to get out of Dodge quickly and is pretty much right on the cusp of giving the property back to the bank anyhow, so they really don't care that much. So if you're able to go in there, help them solve their problem, maybe bring their back payments up to date, perhaps give them a few bucks to help them move on their way, perhaps offer them a way to save their credit so they don't have to go through bankruptcy and foreclosure, because again, a foreclosure can stick on their credit rating for 7 years. That's a long time. That is a big motivator for people. So that's the reason why a seller would sell subject to the underlying mortgage. So what are some of the risks to doing one of these subject to financing type deals for you as a buyer? Well, there's a couple of risks. One risk is you are buying the property and you're buying it with the existing mortgage already placed, which is going to stay in the seller's name. So the risk to you for doing that is, what if somehow the seller manages to get some extra credit from the bank, increases the amount that they owe on the property a few years down the road, things like that. So you have to be very, very careful about that. Also, you have to be careful that if you're making the mortgage payments to the seller, that they're actually making the mortgage payment to the bank on your behalf, right? Because again, the mortgage is still in their name. So here's a quick way around that. Make sure that you're only doing direct deposits to the bank for the mortgage. Never pay the seller and then hope that they're going to pay the bank, because time and circumstances can get to the point where they just keep the money and run and they don't tell you about it. 2, 3, 4 months go by and then all of a sudden the bank is foreclosing on the property. So you have to be careful that way. The other risk that you have to keep in mind as the buyer in a subject to deal is the bank, right? Because again, in all of the mortgage documentation, there's a clause in there that says that the mortgage is null and void, or it's due upon sale of the property. Upon transferring title of the property to a new person, the bank wants to get cashed out. Now, quite often banks are kind of slow on this, so you very well could be on title of that property for months, if not years, before they even clue into that, if they ever do clue into that. But it is a risk. So there is a chance that the bank could call the loan once they find out that you're the new owner of the property. Again, typically, as long as you're making those payments to the bank, as long as they're getting that mortgage paid down, they usually don't care, but that is a big consideration that you have to keep in mind. All right, now let's take a look at what are the big risks for the seller with doing a subject to deal. It's pretty obvious, right? They're selling the property, they're transferring the title of their property to you, but they're keeping the mortgage in their name. That means they're still on the hook financially and legally for that mortgage. So if you, as the buyer, quit making the payments, it's all up to them. It's all on them. So again, that's why we have to get back to what's their original motivation. Are they at the point where they're ready and just at the point where they're ready to walk away from that mortgage and get foreclosed on? That's typically the situation that you're going to be getting these kind of motivated sellers in. So they need to understand that is a potential thing that could happen down the road, and they have to be prepared for that should that happen. So I remember years ago I did one of these kind of deals. I found a motivated seller in a smaller town outside of the city that I live in, and these folks were in that kind of situation. They had purchased the house a couple of years ago. The market had kind of stalled, actually had gone down a little bit, and they owed as much money as the property was worth. They were trying to get out of town. They got a new job. They needed to move. The local real estate market was very, very flat. Plus, quite frankly, they couldn't afford to sell their house. If they put the house up for sale with a realtor. They're going to have to come out and pocket thousands of dollars to pay for the realtor commissions. They couldn't even really afford to sell the property as is on their own, nor did they know how to, and they needed to move quite quickly. So they saw my I Buy Houses advertising and gave me a call, and I took a look at their situation, and that was the solution I came up with them. I said, hey, you guys, there's really no equity in this property. If I buy this property, I need to buy it creatively so I can sell it creatively and make a few bucks. I'm not going to be able to make a lot of money on this kind of deal, but, and I was just very transparent with them, here's what I'm going to do. I'm going to buy the property from you subject to the existing mortgage. You already told me that you're ready and you're about to walk away from this house and just give the keys to the bank and go through the whole foreclosure process. You told me that you're willing to do that. I'm offering you a solution whereby we can avoid that from happening. We can save your credit. We can save the foreclosure from going on your credit score for the next 7 years. We can avoid all of that. And what I'm going to do is purchase the property from you. You're going to keep the mortgage in your name, but I'm going to start making the payments. Thankfully, they were up to date with the payments, so there's nothing behind there. And then here's what I'm going to do, you guys. I'm going to find somebody else who can't qualify for a mortgage, who's going to buy the property from me, still subject to your underlying mortgage, and then they're going to start making the payment, and I'm going to charge them a $3,000, $4,000, $5,000 fee to make all of that happen. That's how I'm going to make some money on this deal. So that's exactly what I did. They knew exactly what they were getting into. The buyer knew exactly what they were going to get into. And in this case, I didn't even transfer title into my name. I just transferred title from them into the end buyer. And that's how I created a nice little, I think it was a $5,000 payday for myself doing that kind of subject to deal. All right, so after this explanation of what is a subject to deal and what's the pros and the cons and the risks and rewards, you might be thinking, hey, that sounds great. I want to do some of those. And that's great, go for it. But here's the challenge. They're few and far between. You have to be really beating the bushes to find these kind of deals. In fact, back in the day when I did my 18 deals in 18 months, I only did 1 or 2 of these kind of deals. All of the rest of them were other kinds of creative deals. So you can't really do much. You can't really build up much of a portfolio if you focus exclusively on subject to deals. But here's the good news. You don't need to. When you learn how to bring on investor partners or joint venture partners, you can do any kind of deal you want because you don't have to worry about the money. I mean, think about it. When it comes to a subject to deal, most people are doing those kind of deals because they don't have the money to buy the property outright, or they don't have the money to buy the kind of property they'd really like to buy. So if you'd like a solution to that, I've got it. It's my book, Money Partner Formula. That's exactly what we show you how to do. It's a formula for finding money partners and joint venture partners. In fact, this is the perfect way for you to raise your first 6 figures or your next 6 figures in the next few weeks without chasing people, without cold calling, without dialing for dollars, without networking or schmoozing, attracting private investors and private capital to you. It's also the perfect way over a number of months to raise 7 figures. We've had lots of students and clients do that as well. So you can get a free copy of the book. I'll put a link in the description below, or you can go to the website investorattractionbook.com. And then that way you can still keep looking for subject to deals, but you don't have to just focus on those. If it comes up, great, take advantage of it, but you can keep growing your portfolio because you'll never be short of cash again.